Rajeev Thakkar joins us now. Let's take a conversation forward. Lots to connect with him, lots to talk with him. What's his view on global FANG stocks is, where he feels value in this market is. Rajeev, good morning. Fantastic to have you back. Let's start with your understanding of the setup, because we've seen not a meltdown, but we've seen a very strong reversal in tech stocks. Select FANG stocks are getting smoked, and India also, the tech space, which in a sense you've heavily invested in, after months of outperformance seems to be hitting a pause button.
Nikunj, glad to be here. I think one has to look at the meltdown in two parts. There are stocks which are down anywhere between 40, 50, 60% from the highs that we saw in the tech space. And there are the FANG names, especially Facebook has seen a sell-off. But broadly, if you see the results of, let's say, Alphabet, which is Google, or Microsoft or Amazon, people have been pretty happy with it, and they are maybe down 20% from the highs, which is more or less a normal kind of thing, up and down kind of scenario. I think given that money is becoming more expensive relatively as compared to where we were, European bond yields have gone into positive territory, inflation is high. This era of free money and just founders selling a vision to investors, saying, oh, we'll run losses for 5 years, 10 years, and we will get profits after a decade, but right now we are chasing market share. I think that kind of storytelling is over. People are clearly not willing to bet too much in the future, and which is also the story of a sell-off in probably something like a Facebook, where the core is not so much of a problem. Okay, user growth has tapered off in the developed countries, marginal dip in user growth. Mainly it's the big bet on the metaverse that they're doing, and people are questioning, meaning, will that pay off or will that succeed or not? So that apart, basically, I think the focus is coming back on cash flows, on earnings. Just chasing a vision or storytelling is past. I think we are going into a dot-com bust kind of thing after almost 22 years, where there will be a segregation. People who can really deliver good business sense versus people who just are burning cash and they will flame out.
How does that change your portfolio approach? Because you do have exposure to FANG stocks.
It doesn't change much, because even in India, for example, we have seen some of the high-flying names where zero earnings or negative earnings, cash burn, story for the future, and they have really suffered at the bourses. So the hype before the listing was there, but then people have recognized that there could be a long haul and not all of the companies will succeed end of the day. So we have not been participants in those kind of names. The names that we own are backed by fundamentals and are backed by revenue and cash flows. So not much change for us. The mid-cap IT in India, we've been sellers for a long time, as can be seen from our fact sheets. So that space, we are pretty much out of it, and otherwise not much change.
Bought into stocks like Hero Honda or Hero Motocorp and ITC in the past. Is that your way of saying that, look, you want to go towards the so-called deep value zone in India?
Yes, I think for a while now, what has happened is the high ROC, high ROE companies have been, or companies which have been showing stable growth, people have been just rushing into them and just pushing up earnings multiples far in excess of what is reasonable. So some of these well-managed companies which have fallen out of favor for maybe 5-6 years, I think those companies could make a comeback. Auto in specific has been having this fear of the big transition towards electrification and electric vehicles, and whether the incumbents will win or whether the challenger companies will win. So that overhang has been there, and plus the demand has been subdued. But I think given that we have been largely at home for a long time, a large section of the population have been working from home or not moving around too much. I think once things normalize, once incomes come to the people's pockets, once people start moving around, I think the demand for auto will come back. And a lot of incumbents already see the writing on the wall and they have their EV strategies in place. So we are not as pessimistic on the auto space as overall seems to be the case in the market.
Good morning, Rajeev. The last time we also interviewed you, you said a long-term investor in the equity markets should not be bothering about the kind of sell-off that we're seeing. I'm sure a lot of your clients are calling you. What is it that you're advising them? I apologize if this question is far too basic, but in a market that's falling and the macros start looking bad, obviously people start thinking, should I take cash off the table?
Sure. So if one is monitoring the stock prices or the NAVs or the indices on a day-to-day basis, then sure, one feels a lot poorer. Maybe the stock prices have come off 10%, 20%, or the NAVs have come down, whatever. But if you look at, let's say, 6-month returns or 1-year returns, they are pretty decent. In fact, we are in a period where the trailing returns are looking extremely good for all equity strategies. So people who stay the course really don't have much to worry about because the trajectory is good. And even right now, when let's say the bond yields in developed countries are anywhere between 0.2 to 1.5 or somewhere thereabouts, or 2%, whereas in India you have, let's say, 6.5, 7% yields. I think equities have a potential of giving slightly better than or somewhat better than the bond yields. But one should definitely not expect the kind of supernormal returns that we saw in the last couple of years. And largely the people who are doing their asset allocation or people who have their allocation to equity, I think should tune out of the overall ups and downs because things have been extremely choppy. And just to highlight a couple of tech names in the US. So a stock was down some 25% before the result announcement, and after the result announcement went up some 50% or 60%. So you are seeing some of these wild swings, and unless someone is a trader, one should not try to time these things and enter, exit, and all that. One could end up losing serious amount of money, and just stay put with the well-researched ideas that one is bought into.
But just given what's happening on Wall Street and the kind of January that we saw, how did you respond? Did you tweak your portfolio for how you folks invest overseas? Have you stopped investing overseas? Are you looking more domestically? What's going on?
Yeah. So have you stopped investing overseas is an interesting question, and which has not much to do with the happenings on Wall Street. But it's more of a domestic thing where, as people are aware, the mutual fund as a sector has hit the outward remittance limit or is very close to that of $7 billion. So SEBI and AMFI have asked mutual funds to not buy incremental stocks or not to remit money outside on an incremental basis. So what we can do is we can shuffle our foreign portfolio by selling something and buying something else, but we can't incrementally buy foreign stocks. And because of that, we have also stopped fresh lump sum investments and fresh SIP registrations. So yeah, you are right. In February, we have not been buying much post the restriction. So 2nd Feb onwards, we can't incrementally buy foreign stocks, and we are hoping for the limit increase to come soon, and the entire sector is awaiting that. Overall, I think in the US market, given the decline in share prices and given the strong earnings in some of the larger companies, I think it's a good opportunity to incrementally invest in, and hopefully we'll be participating in that.
What would be the outlook when it comes to, the entire PSB versus private banking space? Because there continues to remain an ongoing debate. And while we do have the likes now of SBI, for instance, that, we're talking about now how on the back of their numbers, they've shifted towards that operating profit trajectory. Do you think that the case for long-term investments in PSBs vis-a-vis the private peers is now looking a lot more compelling, even basis the kind of returns they've delivered on a year-to-date basis?
The valuations look very, very attractive from some of these PSB names. So if you look at price to book, price to earnings, the trajectory of the asset quality improving and things like that. In the past, what has happened is these things have turned out to be temporary. So after each cycle where they clean up their books, where they say, the worst is behind us, now nothing will go wrong, and look at our deposit franchise and wide branch network and customer base, and we'll come back, then it's proven to be temporary. So after a couple of years, 3 years, again, the lending cycle starts and again, the bad loan cycle starts. So I'm not 100% convinced that the culture shift has happened or they are better organizations in terms of lending or in terms of technology or in terms of customer centricity or in terms of gaining market share. Sure, they are very, very inexpensive. You could see very decent returns in the near to mid-term, but are they buy and holds? I would think not. So at our end, we are sticking with the well-run private sector banks. Although I agree that some of them are looking very, very attractive on valuation basis.
Okay, fair enough. Yes, indeed. Axis Bank, ICICI Bank as well featuring in terms of the top holdings. But Rajeev, let's also get in a view as to what the outlook is when it comes to the entire consumption space. Does it worry you that we are seeing the raw material price, the rising inflation metric as well now disturbing the overall setup? Or do you believe that, they will sort of ride through this phase and emerge stronger?
My personal feeling is they'll be in for some challenging times. So just before I came on the show, I was listening to Nikunj and he mentioned real estate and things like that. So we have seen this happen in the past and slightly distant past, where when people make large asset purchases, especially funded by either mortgage loans or consumer credit, there seems to be some amount of downtrading that happens, or the inflation pressures that you mentioned in terms of the input price, and consequently companies having to pass on the cost increases to the consumer. In such times, we have seen slowdown in terms of demand, even in otherwise stable consumption baskets where these things are seen as defensives. So when people have big EMIs coming on their monthly paycheck, or when people see their consumption basket becoming more expensive, there is a certain amount of down trading that happens in terms of the kind of things that people consume. So plus there is absolutely no comfort in terms of the valuations that are there for a lot of these companies. So I am very, very circumspect on the consumption names, and I would be cautious over here.
Why are you looking at reducing exposure in mid-cap IT? Because one would argue that the trend and the macro setup is favorable. If macro is weak, rupee would be weak, which is a tailwind. But if one takes the variable rupee part out also, the earnings for some of the IT companies is not bad at all.
Yes, so the IT names that we have sold, so the mid-cap IT names that we've been selling, and people can look at that in our fact sheets, things like Persistent and Emphasis that we have sold over the past few months. Now, the stock prices have gone up anywhere from 6x, 8x, 10x kind of numbers. So the valuations have become very, very expensive, and typically the mid cap IT would trade at a big valuation discount to the large cap names. Now that scenario has reversed. So what we have done is we have replaced some of the mid cap IT names with a larger company, and that's what we have done. IT sector continues to remain good and in India, and they should see a decent amount of volume growth in the coming days. The risk comes from the high level of attrition and the challenges in terms of getting talent to execute on the volumes that they are getting.
If one talks about the market which we saw, let's say in 2013-14, which is macro was very bad, FI selling was there. There are two similarities, which is FIs are selling and macro is challenging. It's not terrible, but yeah, it's challenging. Then what happened after that, Rajiv, is that we got into a serious correction in mid and small cap stocks. Could we see that now?
I think one has to be cautious. So rather than segregating the market in terms of the large cap and the mid cap names, I would segregate it somewhat differently. In an era of extremely low interest rates, in an era of maybe zero interest rate or negative interest rates, the low ROCE and low ROE businesses suddenly started looking attractive. If there was some volume growth, if people could spend money on capex and grow, people were indulgent with such businesses. Levered balance sheets were okay because interest rates were anyway very, very low. Or people not having current profits or not having current cash flows, but a big vision of the future, people were indulgent with such companies. I think when the cost of capital overall increases and when the pool of investable money is limited, the buyer will become very, very discerning in terms of what valuation they are willing to pay and what kind of companies they are willing to invest in. So some of the poor quality balance sheets, some of the poor quality managements, or some of the storytelling that has been around saying we will make money 10 years out, those will see a very, very significant correction. And you could see, I hate to sound so pessimistic, but you could see maybe 50, 60, 70% of the stock prices eroding in some such frothy names. So I think one should be careful about what one is invested in, whether it be large cap or whether it be mid cap.
Okay, Rajeev Thakkar, we're going to leave it at that. It's been great having you on the show today with your investment mantra for these times that we are in, volatile times that we are in, how to befriend volatility and not become its enemy. Thanks a lot for joining in.